Thursday. What's up, everybody? Thursday morning. Welcome to today's edition of the Daily Market Commentary. Hope you guys all had a great day yesterday as we're continuing a slow march higher. Yesterday was a little bit of a stall on the last couple of days where we had rallied up off of the hammer candle. But today we're going to do something a little bit different. We're going to look at our four major markets, NASDAQ, S&P, gold, and oil. And then what I want to do is I really want to break down our FANG stocks and really the ones that are oftentimes causing some market movement. I think it'll be good for us to take a look at what are those ones that are causing major market movement and just seeing what are they looking like right now. Because I think that as we start to head into earnings season, because we are coming in on earnings season, and traditionally Alcoa has kicked off earnings season, but I think it's now more Netflix. What is that going to do for the coming market? Now, question of the day, type it in the comment section down below. Do you trade stocks around earnings? And do you have a particular earnings play that you like to use as we head into earnings season for the first time? So let's go ahead and dive right in, starting with the S&P. So here in the ES, we're sitting at 47.16. We're down about a quarter of a point from yesterday. We got our rally up off of this demand area that we talked about earlier in the week. So I'm going to remove that level at this point. We did break out above this line, which made sense for a potential breakout. We got above there, but then it just kind of stalled. It didn't really get below the prior pivot, but it just stalled out. So if you took that, right, 1, 2, 3, 4, 5, 6 candles later, it told you, hey, you should probably move your stop to break even and get out. And it's still going. It's still valid. And when we looked at this, we said, hey, from a swing trade perspective, if we get higher than Monday's high, you have a chance for a swing trade. And so it is still moving for that potential swing trade to make it to the end of the week. But I think that it makes sense if you're in a position like that to move your stop up underneath a prior area of demand and finding an area of demand where it makes sense for your stop to be moved. And so where would that area of demand be? Well, as it stands right now, that line that I just deleted, which was our breakout line, I would go a little bit below there, and probably down into this region here, right? If you took the swing trade, your stop should be around that 4,700 mark. Looking at a place to get long once again, if we come back down into here and show some strength, looking at the 15-minute chart, you could even have a small breakdown trade below this 4,700 as we do see one touch, just about two touch, somewhere in there. I think you've got a couple of areas down here a bit lower. By the time we get down there, your momentum is probably going to be pretty strong to the downside, and I don't know that a 15-minute level is going to stop it. It might slow it down, get a little 2-to-1 bounce off of a level like this, which is a nice little wick over wick area here on a 15-minute chart. You may get a little move off of that 15-minute level, but I don't know that it would be something that I would want to spend a lot of my risk capital on, because we would already have changed the momentum, and our trend would be firmly entrenched to the downside at that point. But I'm going to mark it off anyhow, because I think it could still be a valid little level, a valid little play, and it would show up on the 1-hour chart right about in here. Okay, if we get basing there at 4,700 and you want to try to take a little bit of a move down, I think that's okay. I would take a 2-to-1 reward to risk off the table, though, pretty quickly. The NASDAQ, looking at the NQ. So the NQ, we had a breakout point. We did hit the breakout point, and then it rallied to the opposing area of supply. So that opposing area of supply right there is where we stopped going up and started to head back down just a little bit. Now I'm going to remove that supply level, and I'm going to remove that breakout line. And similar to what we did with the S&P, look to see, okay, if we break below here, where do we then fall? Well, sliding to the 15-minute chart, we can look and see a bit lower than where we are today, where that 15-minute level of demand might be. And so that 15-minute level of demand, as I look a bit lower, if I come all the way down to here, which is Tuesday mornings, right after Tuesday morning's market open, and the big strong move up, I don't have as clear of the wick over wick level in this one. I do have a pretty clean wick over wick right here um, in the NASDAQ, which makes that breakdown trade a little bit less probable in that wick over wick at a prior area of resistance. And so that gives me a little bit less confidence in the breakdown trade. Now, by the way, can you still make a little bit of money from here all the way down to here? Sure, as a day trader, if you can pick up 20 or 30 points in the NQ, that's a pretty good little run for an intraday trader. So it might still be well worth it. It depends on what our breakout looks like or what our prior pivot looks like at the time of that breakdown. Don't know that that breakdown is going to occur today, but I'm just trying to be cautious of the stall. Now, you could very well still be in a swing trade position in this one as well, because I think that we can continue to rally higher. Now, if we're unable to create a new swing high on the daily chart and we do come back down, that actually would be very telling because we would have a lower swing high in the daily chart. Sliding over to, let me take a look at crude oil. So looking at crude, we had talked about a breakout trade in crude, but we didn't get the basing to allow us to get an entry. And unfortunately, we then didn't get a true retest area for us to get long. And so looking at our crude oil level, let me get rid of this level here. Sliding back to the 1 hour chart, there is this little 15-minute area in here where we could see a reversal, or you could see another breakout trade, right? Keep an eye out for another potential breakout for price to continue to trade higher. This would be our 15-minute crude oil level. Remember, on our weekly chart, our much, much longer term weekly chart, right? Going back a lot further, this was the area where we had determined, I think, is the price magnet. We're coming up very strong here in crude oil over the last few weeks to challenge that level after what was, frankly, a pretty deep pullback. To see if we're going to challenge that $90 a barrel level. And then we've got gold. So looking here at gold, our breakout trade above 1833 is still in place. The hourly level of demand down below us is still in place, and we just haven't retested any of those levels in the last day or two for us to have much of a great trading opportunity. We did bounce off of this area of supply earlier in the week and got a little move away from that area of supply. Retested a second time, pulled away. Retested a third time and blew right through it. But we have been unable to get through this swing high right here, this pivot. And so by being unable to get through this swing high, sellers are still in control. We've got to get through this, and then I'm going to require basing to happen somewhere below here for a true breakout trade. But it's grinding up in a way that it's eating away at those sell orders that exist up there. Taking a real quick look at our crypto futures, starting with Bitcoin. Looking at our micro Bitcoin futures, we just about made it to our confirmation supply area up here, but it just didn't make it in deep enough to give us an entry. It was just a little touch and go off the level, and all the same, it has slowed down its momentum to the upside, and so we certainly don't want to be trading more basing in front of a level. Right now, I think I'm just going to hold off and not add anything new to Bitcoin, because you've got a nice base that formed down in here. You do look like we're starting to head up a little bit more, with a little bit more, oomph to the upside. Looking at this on more of a daily chart, I would not be surprised to see us rally back up into this region here at about 45,000, and then reverse and head back down. That's what the trend is telling me right now. Once again, follow the trend, trust the trend. The trend is your friend till the bend at the end, and we've not bent yet. And then looking at Ethereum. So Ethereum rallied into our supply area yesterday afternoon that we had spoken about yesterday morning, and we got a nice little move away, about a 3-to-1 move away on that Ethereum level, and it's continuing to move down. So if you're in this one now, I think it's time to take your stop and move it to break even. If you didn't take that one, then I don't know that I would get in now. The area that I will pay attention to today, though, because like I said, we formed a bit of a base, is this area right here, formed at a pretty decent time of the day, right around the London Open, where we had a little bit of a rally-based rally. And I think that could be a decent reversal point for Ethereum to continue to head back higher, as just like Bitcoin forming a bit of a base. But we head back a bit higher. I think you've got 3,600 would be where I would think that reversal would come for price to head back down in Ethereum. So those are the two crypto futures worth taking a look at for today. Couple in the currency markets. The euro has really broken out. Strong move yesterday. Came through the opposing area of supply. But our supply area here is confirmation supply, since our trend was now officially up. So being that it's a confirmation supply, it didn't really give you a chance for an entry because it blew right through before getting an entry on that confirmation. Now, I do still think that your hourly demand is here and very strong. You've also got some, the most obvious simple hourly demand below the most recent strong candle higher as a place to rejoin this big picture trend. Now, that one seems almost a bit too obvious. The one that I'm looking at is this wick over wick right here. Now, why do I look at this wick over wick? The reason I'm looking at that wick over wick is because looking at this candle right here, you'll see that long lower wick. And the long lower wick means that at one point this was a red candle all the way down to here. So that means that this is a rally base and then a strong drop, and we dropped away from it. The very next candlestick after that, what you'll be able to see, is a little bit of a wick over wick. So this is a hidden wick over wick above a pivot low. That's what this is. This is a hidden wick over wick above a pivot low. And those are areas where oftentimes you see reversals. And so while I like this level here formed right at the London Open, or right before the London Open, I like the level below it a bit better, and it's a bit more of a trap level where a lot of investors might be looking to get short below a breakdown of 1.1, of this 14483. That's where you've got a good trap set up for a long. All right, let's go take a look at our stocks. Our Apple, Facebook, Microsoft, Amazon, Google, and Netflix stocks. As kind of the ones that drive the markets. And we're going to start with Apple. And Apple on a daily chart, looking at our daily chart of Apple, I'm going to throw some indicators on here because I think that these indicators do matter when it comes to some of these stocks, because there's a lot of companies that utilize the moving averages to determine, okay, where do I get in, where do I get out, where do I add to my positions, things like that. The thing about Apple that you'll notice first and foremost is a divergence of momentum. I'm getting roughly the same swing highs, and I'm getting very, very divergent momentum on the swing highs in the MACD. And that typically shows that we have some weakness afoot and that there's a chance that we're going to roll over and come back down with a bit more strength. So with that being said, we have rallied up over the last couple of days, and we've gapped up. Let me throw my volume on here real quick. Sitting just below the 20-period moving average, but still above the 50. So we still are above the 50-period moving average. And if you notice, our rally up the last few days has occurred on lower than average volume. So by occurring on lower than average volume on our rally higher, that tells us that, hey, we could have some signs of significant weakness coming forward. If our down days show on increased volume, then that would be another indication that we could start to see some weakness in Apple. Now, certainly weakness in Apple definitely means weakness in both the NASDAQ and the S&P. So that is something to pay specific attention to. Next would be the meta universe, the meta platforms, Facebook and its meta platforms. We're off the high by about $50 a share and really haven't come back to retest that high. You notice Apple just put in a new all-time high. It's hard to talk about Apple being bearish, even though we're only $7 off the all-time high, but it's definitely giving me signs of weakness. The meta platforms are about $50 off their all-time high and not close to recovering that all-time high. So I don't know that I'd be jumping up and down to trade this right now. And I've got a convergence of all of my moving averages. We're actually below the 200 period moving average, and we're below the 50 period moving average, and we're below the 20 period moving average. Just barely below the 50, but we're below the 50, the 200, and the 20, which is we're sitting right at a convergence of major moving averages, and we've dropped below both of them. I want to take a look at the weekly chart right quick and see. We're below the 20-week moving average pretty substantially, and just above the 50-week moving average, where we got a little bounce off of that. This, once again, shows signs of a fair amount of weakness for the tech sector with these meta platforms. Next would be Microsoft. Microsoft also showing a bit of momentum slippage. Momentum slippage is strong in Microsoft. Off the 349 high, we're sitting at 318, so definitely a lower than the high. Yesterday's candlestick is a pretty bearish candlestick, right? Which is why we talked earlier today about taking your stop and moving it up in your equity markets, because our bearish candlestick from yesterday could continue into today. Amazon is way off the highs. Continuing to kind of head back down, I think would be the next most logical step in Amazon. And our daily trend is down, right? So we've rallied back up over the last few days. Let's look at our volume on those rallies. Our volume on those rallies are below average volumes, so not a tremendous amount of follow through has occurred in those. And so there's a little bit of concern there. Google looks probably the strongest of most of these, although it's definitely got lowering momentum as well. Average volume on the last few days up has actually been slightly above average volume. But if we were to gap down today, which I don't know that we're going to, but if we're to gap down today, that would set up for an island reversal. So just keep that area in mind as well. And then Netflix has earnings coming up in the next few days, and it's in already an existing downtrend. Now, we did come to an area of demand that I thought we might get a decent bounce, and we did not. It just blew right through that. So demand levels are being violated. That means that supply levels will more than likely be respected, and with the respect of supply levels and violation of the demand levels, that is the hallmark of a downtrend. And I don't know that I would be looking to get long anywhere in Netflix. I would be looking for shorting opportunities. So what am I saying overall? Well, looking at these 6 stocks, Apple, Facebook, Microsoft, Amazon, Google, and Netflix, they're not boding a tremendous amount of confidence for the market's bullishness in the next 4 to 6 weeks. And so I would maintain an air of caution. Yes, we're rallying up in the S&P over the last few days, but we are not seeing that the stocks that have really driven the market are set to sustain that move up. Okay, and I think that's something to be a little bit wary of. So that's all I have for today. I hope you guys liked today's stock analysis. If you have any questions, give me a heads up. Go to tradersarmy.com. You can learn more about what it is that we do. And if you have any questions, send me an email, support@tradersarmy, or leave it in the comments down below. Thanks so much, everybody. Hope you guys have a great day. See ya. Hey, thanks for joining us. If you like what we do, please make sure you hit that subscribe button. It's the only way the computers know that you're actually alive and really care. And go to tradersarmy.com today to learn a bit more. And if you want to see some of our other videos, click here in the box.